Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Cem Karsan and I, Niels Kaastrup Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Cem, it is wonderful to be back with you this week. It's been a while. How are you doing? Is Chicago all dressed up for Christmas?
Yeah, I got my flannel on here. We got our first snow of the year last night, so nothing that really stuck too much, but it has been unseasonably warm throughout the year. And Chicago, global warming is a thing. Like, come to Chicago, like it's been beautiful here. But no, we got our first snow, so we're getting ready for the holidays, family coming in, all the good stuff.
Well, that sounds very nice, actually. Yeah, it was actually snowing when I drove down to my office just a little while ago. But I will say, I was in Singapore last week, and it is really interesting. They really go all in on Christmas. I've never been there at this time of year before, actually. And not only do they have all these decorations in the streets, I mean, it's insane, but they also play loud Christmas music in the streets. And then you walk around, and as a European, of course, you're doing this while you're sweating at 33 degrees Celsius and massive humidity, right? So it's such a surreal experience.
I often go down to Arizona to my in-laws for Christmas, and it's like inflatable cactuses with like Santa Claus hats on. It is talk about surreal. Yeah, it's but yeah, here in the U.S. we do Christmas big. And in Chicago, I'm going to a tree lighting ceremony along Michigan Avenue, and there's like a whole there's a whole to do. And this is like literally the day after Thanksgiving, so it'll be fantastic. It's quite a scene.
Absolutely. Okay, well, we've got a list of really important topics that we're going to be tackling today. But as you know, I always, especially at a time like this where it's been a little while since we spoke on this series at least, I would love to hear kind of what's on your radar outside the topics we're going to be addressing later on today.
It's a moment, it's a trajectory moment, right? And not just in the year, but really kind of in history. And I think it's hard to not be aware of that and thinking about those effects. We've been talking about regime change, like here broadly, like that we are broadly in a very different environment than we have been for the last 40 years. And I think we've seen that. As we've talked for the last 2-3 years, we continue to go down that path. And those things are not linear when they happen. Sometimes it goes very slowly and then all at once. And I think you have to be prepared for the fact that things have gone slowly in that direction, but really had the possibility of accelerating all at once here pretty quickly. So I really do feel in many ways that this is a calm before a bigger storm. That storm doesn't mean a crash necessarily, but a bigger acceleration into a broader regime change. And so there's a lot of questions about that. That's what's on my mind as we head into the holidays. Yeah,
no, absolutely. And we'll touch on some of those topics for sure today. I think as for me, I was thinking about what's really been on my radar. I mean, one was just the experience of being in West Palm Beach the day before the U.S. election. That was also an interesting experience, I have to say. Luckily, it was very peaceful. But then now that I'm back in Europe, as a European, I obviously are thinking about what will this new Trump administration really mean for Europe. And of course, as a starting point, it's the Ukrainian situation. Because if you go by what was discussed during the election campaign, the support for Ukraine can, go away very quickly, and I just don't think Europe is ready for that. And so a lot of that has to do with Russia. But of course, then I'm thinking a little bit further down the road, and I'm thinking, well, hang on. I don't know if you followed the news. It's maybe not world news, but in my country of birth, Denmark, in the last 48, 72 hours, we have been holding back a Chinese ship that they are. The suspicion is that it has caught another 2 fiber cables in the Baltic Sea in the last week or so. So if it's the Chinese now doing this, I'm not saying it is, but if it is, it just opens a whole can of worm. And I know we're going to be talking about all these geopolitical issues, as we have done in many of our conversations over the years. But it is, it's just super interesting time. And I think your wording of regime shift covers it so well, because it's going to be different on so many levels that we can't imagine, I think.
Absolutely. Couldn't agree more.
All right, good stuff. All right, quick trend following update before we dive into all the juicy topics. It's not always that trend followers are on the right side of an event, especially if it's one of these events that is going to happen, like the election in the US. But so far, at least, the US election has in large part been in line with the overall exposures of trend followers in the aftermath of the election. Long equities and the dollar has certainly been profitable. Avoiding long exposure in bonds has also helped. But as far as I can tell, perhaps an even better sector for trend followers so far in November has been soft commodities, like coffee, like cocoa, both of which are up about 20% so far this month. So that shows you the power of being truly diversified. What seems to have hurt trend followers a little bit following the election is being long precious metals. And I think we're going to be talking about gold a little bit later on today. My own trend barometer stood at 41 last night. That's a neutral reading. It does look like longer-term strategies are doing a little bit better than what the readings suggest. As of Tuesday, beta 50 up 1.72% in November, up 3.67% for the year. SocGen CTA index up about 1%, only up about 20 basis points for the year. SocGen trend up about 2% and just slightly positive for the year now. And the SocGen short-term traders index up about 0.25% and up about 14 basis points so far this year. In the world of traditional investments, MSCI World is up about 2.5% almost in November, up 17.78% so far in 2024. The S&P US Aggregate Bond Index is down about 31 basis points this month and up about 2% so far this year. And the S&P 500, of course, still powering away, as Cem, by the way, has forecasted for a long time, up 3.8% this month and up 25.6% thereabouts so far this year. Now, before, Cem, we dive into the topics, we did have a question in from Adam. Adam wrote, I have a question for you. Not sure whether you trade or know who does VIX futures. Well, I certainly know someone who does trade VIX futures. But here's my question. I'm trying to gain exposure to VIX as a daily swing trade now for a $2.5-3 million trade. Would it be more efficient to gain exposure directly to the futures for a daily holding period or buy the ETP-VXX? Curious about your thoughts on this around trading efficiency, given there are futures and ETPs that hold futures. And P.S., he says, I'm a retail investor. All right. Any thoughts?
I always better to go to the direct source, right? These ETPs are sitting on top of the VIX futures, right? So at the end of the day, there's you're paying market makers extra edge, in these ETPs because they have to rebalance. There's all kinds of other costs on top of that to the ETP. So if you're talking about just pure efficiency, VIX futures are more efficient. They're also more capital efficient, right? They're margined as opposed to, you're talking to a derivatives guy, like capital efficiency matters, especially in a world where interest rates are 5%. So, not even a question for me. I'd go straight to the futures. And I think it's a pretty simple answer.
Okay, cool. Well done. All right. So now we're into your topics, and you gave me a few headlines, and then I'll try and follow along, and also follow up with some thoughts and comments and questions for you, Cem. But the first thing, not surprising, I guess, that we are going to talk about is volatility and the volatility compression and dispersion into the end of this year. You mentioned specifically just NVIDIA, so I'm excited to hear where we're going to go with this.
Yeah. So one of the big concepts that we've talked about on the show, but if you haven't tuned in for some time, is how correlation of constituents in stocks in the market are tied to volatility. To break it down in a very simple sense, if volatility is compressed, is offered on the index level, if it's very well supplied and dealers and market makers are long, that pins the index, right? But the counterintuitive part is that the underlying constituents actually get pushed away from each other. Think of it as a magnet with a positive and a negative. If the vol is really well supplied at the index level, that means the index can't move. It's stuck, right? But there's still something called idiosyncratic risk, right? Things still have to move. At the end of the day, a positive set of news comes out in a name, or something very bad happens, there will be a reaction to that single stock, especially if it's not a big ball center itself, right? There aren't major other effects. If that happens, that means something has to go the opposite direction. Like by arbitrage constraints, if the index is pinned and something moves in one direction, then another thing has to move in the other direction. And so what that does is that actually exacerbates volatility in the constituents, if you think about it. Maybe not as a whole, right? Because again, the index isn't moving. But what that does is it breaks down correlation. We've seen this at scale more and more. If you look at a chart of correlation is actually breaking down. At the end of the day, there's been less correlation between constituents than ever. And it's been secularly that way. And people will point to, well, we live in a world of regime change, et cetera. Yes, that's true. That is happening. But before all this regime change started happening, was also happening, right? 2017, we saw a historic, we've talked about this before. I think this is the most important data set for this. We had 30% lower implied and realized volatility than any other time in history. 120 years, you do a chart, a scatter plot, it's like a massive outlier, right? Usually massive outliers like that don't happen without a reason, right? The other interesting part, right, and this is not coincidence, the odds of this being coincidence are essentially zero. You had 25% lower correlation between underlying constituents than any other time in 125 years. Again, look at the scatter plot, massive outlier. Those two things are intrinsically tied. And again, they're tied for this reason, particularly in this scenario where the index itself is pinned by something. It's the index that's being forced to be pinned. Idiosyncratic risk you're never going to eliminate, right? That's the definition of idiosyncratic risk. And if you have idiosyncratic risk and the index is pinned, that means things have to move. That concept is incredibly powerful, incredibly important. And it is an edge. It is a source of alpha for people. If you understand that and you understand what's happening in the volatility line, you have an edge. You understand that things are going to move away from each other. It's not a directional edge per se, but I think so few people understand that most of the edges, truly true alpha, it's generally not directional, right? It's generally market structure dynamics that lead to different dynamics in distribution outcomes. And this is a critical one. So having said that, now drilling down to now and what's happening, vol is very well supplied. Why is that? Often after a big event, this happens, right? We had the election, and the election has passed. That event vol has come out, and that was a very high vol, and the vols behind it were lower. So there was this great opportunity to sell higher vol to buy lower vol. And as long as you could manage the gamma, which was relatively manageable, all things considered, you have now been delivered longer vol at a much lower level. And that brings the whole curve down. And this is you get into a circle, right? Because the more it comes down, the more dealers are long. The more dealers are long, the more they are having to be on the offer. And until there's a buyer to help relieve that pressure, it cycles down. It compresses realized, which compresses implied, et cetera. Eventually, this gets to a low enough level. And markets, the way this generally resolves is on the upside. The market rallies enough that the market slides to a lower implied volatility because calls are priced in a lower vol, and eventually becomes so low that there is a impetus. The realized volatility on the upside tends to outpace it, and there's an impetus for people to come in and buy vol. Also, entities are short call. They write calls against their positions. They have to buy back their calls. They're making money, so they usually go buy puts to hedge as well. So there's a general, as you rally and you slide to a low enough vol, there is an impulse for the market to kind of come back and buy back that vol eventually. And so until that happens, vol is compressed. And we are seeing a massive amount of vol compression across the board in the shorter dated, meaning 1, 2 month, et cetera, vol. That's likely to lead to dispersion. And that's what we're starting to see. And again, people will point to regime change and regiment, like all these things that are happening, new administration. Those are true. But understand there's a structural reason, there's a wind at the back of those dynamics as well. That's likely to push things away from each other. So these tend to be times of rotation. We're likely to get increased rotation into the end of the year for the next several months. And that vol compression is only going to be exacerbated, by the way, by Thanksgiving and Christmas and all the positive flows that don't just come out of these bond and charm flows from the skew, which I've talked about at length here, right, in December, and all the structured products at the end of the year, but also that releveraging effect that we've talked about at nauseum that comes into the end of the year. This next month and a half to 2 months, really call it 2 months because it's really through early January, is likely to continue to not only push the market higher, but compress volatility at the short end of the curve and lead to dispersion. So that's the big takeaway.
Can I ask maybe a silly, naive question, but I just want to try and understand this. So as markets move higher, we know that volatility often come down, right? And then at the same time, you're saying, well, dispersion is growing, so correlation is breaking down. So intuitively, you would think, well, if markets move higher, it means that all stocks must be going higher. What you're saying, that's not necessarily the case. And is this then, if I'm understanding this correctly, is then this kind of also related to the fact that the rally is narrow, meaning there's not a lot of breadth? Okay.
Yes, it is a major driver of the breakdown of breadth. There are other drivers which are also exacerbating, like passive flows, which other people have talked about and are definitely true as well. But 100% vol compression into rallies is leading to correlation breakdown, which is also by definition hurting the breadth. And again, it's multivariate, right? All of these things are. It's not everybody would say, well, this is what matters, or is this what matters? It can all be true. And this is a major force. It's an important one that people need to be aware of. Passive flows are also important. But 100%, the breadth breakdown and the breakdown of correlation are intrinsically tied.
So maybe as a follow-up, and I know we're not giving investment advice here, but I'm just curious about the mechanics of this. If fund managers out there are seeing this, how do they take advantage of it? But also at the same time, how do they know when it's coming to an end? I mean, is it just saying, well, we have to wait for the markets to turn to see this reversal? Because you would think that maybe if markets really sell off, that could also, well, I don't know about how breadth would be affected by that, frankly. But so how do people who's observing this, how would you take advantage of that?
Yeah, the way we take advantage of it is we watch very closely what's happening in the vol markets, right? That vol supply is the key, right? In terms of how do you watch that, there's several ways.
Oh, no, sure. No.
So at the end of the day, but to be clear, I want to make sure I also am clear. Most people, and I really try and dispel this is so critical, and it's easier than people think. The VIX is not what you should be looking at to understand fully. I mean, yeah, it's correlated, right? It's vol, but it is not a pure representation of what is happening in the vol market because there is skew in options, right? There's a downside, much higher volatility, implied volatility on downside options versus upside. So naturally, if you go down, the VIX will show upside. Like the VIX is, if the market goes down, the VIX will pop. But often, more times than not, actually, the actual underlying vol is coming down. And so understanding what those vol dynamics are, price, as most people know, and other products matters. It's a reflection of what supply and demand is telling you, right? Price is a great way to understand what's happening to supply and demand in the vol market. You can know what the dealers hold or they don't hold. That's the best. But if you're a retail player or don't know those things or can't track it, price is also very helpful. And that's kind of a little crumb. Like, people should be watching price on the underlying options, not the VIX, on the underlying options and what's happening to the fixed strike vol of the surface. And again, that's not as hard. It's not a two-dimensional thing. You have to look at a lot of options. But in this day and age, getting options vols in and then taking one price, set, and then looking forward at the price, like, you can do that. Those are things that even retail can do.
Yeah,
that's what I would recommend.
Yeah, no, that's amazing. You mentioned in your topic line NVIDIA, for example.
Well, rotation, right? So now the next step is we know this dynamic is in play here into the end of the year, and I know people always say, we know this dynamic's in play. Now, things can change. You can have other factors. Vol could go bid, and that dynamic may change. But this is a high probability factor, probability to watch. So given that, what rotations are we likely to see? So that's the next step, right? And that's a harder question. And again, not one that we have to say 100% this is going to happen. That said, if you want to start trying to look for places where things can rotate, one good place to look is short vol areas in the market, because the long vol areas of the market are likely to stay pinned with the rest of the market and not be the places where correlation breaks down. NVIDIA clearly is one of those. Interestingly, the Russell has become one of those. It didn't used to be. Because of so much upside call buying, it started last July. We talked about some of those dynamics that led to that helped exacerbate at least the August decline dynamics. And so there's a really interesting kind of bifurcation in the market of different short vol areas. And the rotation that we're likely to see is likely to involve those entities. Not only those entities, but those things are a likely counterweight to one another. Now, what's likely in between those two? And now, next question, to go up versus down. Well, let's we can go through the analysis of that. And there's no right answer here, by the way. But if you look at NVIDIA, it's flagging in a lot of ways. It's tried to push up. It's had incredible momentum, and that momentum is slowing. The earnings yesterday were, as I would have expected, good, but not great, right? There are some worries. We're not going to get into all the names about accounting issues and all kinds of things, right? That I think are legitimate. They're not just kind of narratives. They're serious potential issues. Now, that doesn't mean, by the way, we're talking trading. That doesn't mean AI is not going to be the future, or that, I think people come after me right away. Like, how could you bet against AI? That's not what I'm not betting against AI, right? Please don't come after me on social media about any of this. It is simply factors and likely probabilities. So, and meanwhile, we're talking about America First policy and things that largely are more likely to benefit kind of smaller cap domestic stocks. And so there are other pressures and narratives and things that have create a wind at the back of the Russell as opposed to a headwind, in my opinion, to NVIDIA at this point. And again, happens slowly and then all at once, but it would not surprise me if we continue to have pressure, like vol compression, steady grind higher in the S&P. Meanwhile, things like NVIDIA start to lag and then can continue to do not as well, while things like the Russell broadly do better. Now, again, go pick your favorite names in there. I also think I mentioned this elsewhere, like meme names, have a tailwind in the form of the new pumper and chief,
we'll
Elon
get to that one.
Elon Musk, you think the bully pulpit is important normally. Now take Twitter as a microphone. and add that to Donald Trump and Elon himself. It's not just Twitter. Elon himself is, no matter how you feel about him, right? He's done an incredible job pumping Tesla stock over the years. You could argue that Tesla would have gone bankrupt years ago if he wasn't able to get the call squeeze and things going on in Tesla early on. He is a narrative genius. He's been able to kind of push investment into his names at low cost and go through years with lack of profits and successfully. Again, this is not a negative commentary on Elon. He's done an incredible job of that. It's genius, but he is going to use those tools again. And that's what he did politically. By the way, he helped Trump politically. There's no doubt about it among the younger cohort that his support of Donald Trump was incredibly powerful as well. So heed that and think about, again, if we're getting rotation, short vol areas, again, narrative names are one of them. So running of the memes is likely to be a thing again.
Sure. Yeah, we'll get to, I'll come back to Elon in a slightly different way a little bit later. I just want to mention also that, it's interesting you mentioned this. I was listening to Professor, actually a previous guest of ours, Professor Ashworth Damodaran, and he was talking about specifically, what he thinks about AI and the Mac 7. But he basically felt that these things were overvalued in his view, and he also mentioned that he had sold half his Nvidia position probably a little bit earlier than now, but there we are. So it's a fascinating area. Before we go on to the next thing, while we are on the topic of kind of stocks in general, first of all, I want to acknowledge you for being so consistently right for many, many months, talking about and guiding people through the ups and the downs, really, through the equity market. And I wouldn't mind if you could just very briefly recap kind of why you kept that view and whether something surprised you or it really just played out as you expected, because it's going to set us up to when we get to the point about what happens next, I think.
Yeah, a good time to talk about the year.
Yeah.
The whole year. And I think it's good to self-reflect at this time of year. We came into the year cautious. We were a little wrong. I want to be clear. I was very, very precise in the wording for a reason coming into this year. The Fed pivoted in December of last year. And they really surprised us and everybody else. We priced in 6 cuts last December. People forget. Years move very quickly.
Yeah.
And then all of a sudden they had to pivot. We said when that happened, like the Fed's like, this is crazy. Like the Fed, there's no way the Fed is going to be able to stick to this. Like inflation is going to be stickier than people expect. The economy will be stronger than people expect. And part of that was reflexive because you lower the rates. And I think they know that actually. They lower out the long-term rates. And guess what? It's stimulus, and a quarter forward, all the demand comes back, right? We saw a massive amount of sequestered demand in the real estate market here in the U.S. be unleashed because people, millennials around have been waiting for an interest rate break, and they got one early in the year. And going into the spring, that was brilliant. I think the Fed is on to something here. If they every end of the year start, reflecting that they're going to cut aggressively and they can bring down the long end of the curve, which they're not able to do this time, interestingly, which we can get to, they are going to push a spring push and get the economy going in the beginning of the year. It works. Mm-hmm. It's not. And by the way, it's just a narrative play. And then they can not do the 6 cuts. It doesn't matter. And then things kind of work themselves out.
And can I interrupt you here just because we may not remember this? You were also very early, I remember from our early conversations, you were also very early out talking about, be aware, this is an election year.
Yes.
And I've done my study on that. So just want to mention that.
Yeah, exactly. And I was going to get to that. So,
okay.
So absolutely. So in January, we said, look, there are these windows where after a big run at the end of the year, you have to be cautious. right? And we're talking about that again for next year. That's consistent, and particularly consistent in up years. And guess what? 23 was up year. We had a good rally at the end of the year again. Not as up as this year, right? That's a whole nother story. We've talked about that. And it's election year, so there's more vol dynamics, et cetera. It's even more powerful this year. But, especially with the Fed stimulating late last year, starting Nov 1, we called like a rotation, massive rally, got all that spot on, made a ton of money Nov 1 till January. We were like, okay, time to take a break, see if things we get a pullback here in January. And we were very tailored with the trade. We said there's a 1.5 to 2 week window here where you got to start seeing something, or because this is election year, you got to be careful. We took that short look in early mid-January briefly, and February. Didn't happen. Literally mid-February, we said, you got to go long. You got to go aggressively long, and you're going to be long the rest of this year. And we were very adamantly pounding the table, literally from February till August, right? So we were incredibly right during that period, obviously, and right before we had a couple of tailored, and this is the be water thing. Like, you got to sometimes betting not long in the market, by the way, is the hardest thing you can do, and it's where we have real edge, honestly, because if you do it in a tailored way and you're very specific, you can really add great risk adjusted returns and improve your short. Anyway, so we get to the summer, and we were very clear, similar to what we're talking about now. Summer of George, vol compression. You're likely to see a much more of a grind. It's a good time to sell short-dated vol, buy long-dated vol, right? So importantly, you're not just haven't been right just on dynamics of direction of the market. Made a ton of money we didn't have anything greater than a 2.5% pullback for 3 months, May, June, July. We were very clear. Vol compression was, this plays into your question. When do you know? How does it, because when it breaks spectacularly. By the way, that 2017 period we talked about, it broke with the Volpocalypse, right? That's something you should be very aware of. When it breaks, it's going to be dramatic. And this, again, ties into the end of the year, which we'll get to in January, February now. But we said we will get a vol event in the fall. And that vol event will be a wobble, 10% or so, we said. We targeted likely September. It happened in August. It happened early. So that was, again, something we didn't get perfect, right? Again, getting every point and pivot exactly right is essentially impossible.
Exactly.
Right. But if you step back and look at what we said, every single quarter, I'd say the exception with that Jan Feb with a couple of weeks in there, spot on, not just what happened directionally, but what happened to vol, and the dynamics and the characteristics and distribution of the period have been 100% spot on. And again, we got massive vol compression. Then we got a vol release, 10, 11%. And we said, we were screaming from the rooftops, this is your opportunity. This is what you've been waiting for to get back in. The end of the year is going to be a massive rally, and that we should hit 6,000 to 6,200 end of the year. And that will be, not just end of the year, but by mid-January, maybe even higher. And that should be a period, again, to hedge and to be careful. Now, we may not get the decline in Jan Feb. I'll tell you people right now. By the way, we called the 22 beginning of the decline to the day. You can go back. We were on to this show. We were on other shows. Literally called that 6 months out. So these dynamics are real, and they are periods to be very, very careful and look for convexity in those periods and be hedged. But this year in particular, part of the reason we had such confidence in the rally throughout the year, not just the vol dynamics, but the election year dynamics. And you and I talked about that at depth. The long and short of that was the data speaks very loudly about election years. People think generalized election years are very positive. That's not the case. If you look back to the 1920s to the present, 100 years of election history here in the U.S., the numbers say 11%. Okay, everybody's like, wow, those are 11.5%. Those are great numbers. But what people don't realize is if they look at the data, if you take 64, 68, 70, 72, 76, 80, those 5 years out of that data set, just 5 elections, all of those together were up an average of 21.5%. None of them were down. All of them were up double digits, so incredibly consistent. And if you take those out of the data set, the number for the 100 years of history is actually 5%. So election years outside of that period are not positive. And what makes it so impressive, again, you can kind of look at the data and pull whatever data and get whatever results. What makes it so impressive is that if you look at that same period, that's the period where the market went nowhere. That 68 to 82 period, which we've highlighted ad nauseum here, the market went nowhere for 14 years and lost 70% of its value in real terms. Yet, all the election years during that period were up double digits, and the average was 21.5. So what do you think that data period looks like when you pull those election years out? And, okay, this is data. Let's not talk about qualitative, all right, let's dive into the qualitative. Why? Pretty obvious, right? You're in this populist period that we've talked about in depth. Actually, before I looked at this data, I had this thesis and I looked at the data and I was like, holy cow, it's right there in the numbers, right? So it's not like I looked at the numbers and said I came up with this thesis. It's very clear. Populist periods, these are contested elections. You have massive turnover. Again, data-wise, if you go look at all those elections, the average period that somebody stayed in office during that period was 4 years, either by getting kicked out of office, assassinations, or getting kicked out of office. The average these days is 7, right? So contested period, people are not happy, people want change, populists, and guess what? They're feeding money to people, feeding money through Federal Reserve policy, and they're pumping the market to get elected. We'll worry about tomorrow later. Get the voters what they want. Right? But eventually you got to pay that bill. And it ends up getting paid in the years prior. So here's your big picture kind of idea. And by the way, also, probably not a coincidence, the last 2 elections, right, which I've also defined as populist elections that were in this populist period. The last one was 21%. And this one, we're now at 25%, right? So again, maybe not a coincidence. Maybe we should look at the data. So again, you can't put all your eggs in one basket and go all in for that reason. But then you take that as part of a bigger picture, look at the flows, understand the micro, what's happening, and this is where you end up in a good predictive kind of position and end up getting it right. So that said, I think you can insinuate what I think, is likely to happen in early next year. Again, I see this end of year period as more positive, with more positive flows than the summer, but vol compressed similar to the summer. I see again, we already talked about the dispersion and everything else, but I see this giving way ultimately to about a volatility and about and a decline, and something that's much more than a wobble that's to be aggressively bought. So a word of caution come January. It doesn't mean be cautious now, because many, many times, most times, the best returns happen at the end. And again, a lot of tailwinds until mid-January. And again, we can call, people love it when I call dates, because when it ends up being right, it's the precision that's important, right? Sometimes.
Sure.
But again, I would focus on a January 13th to 15th window as being your first shot. Again, tailored trade. It's a hedge. Look for convexity in that portfolio. As we play it, time up. There's going to be a lot of really important indicators. Again, we've kind of talked about blow off tops and what unpinning a vol looks like and how important that is. I think it's something you look for those things at that moment in those windows. It will never be easy, right? So something much like the 10% wobble came in August, not September. Look for some variation off of this that's not going to be exact in terms of timing or path. But the trend still holds. And if it doesn't happen in January, I would be very, very much looking at February as well. January is a better window in some ways, because it comes sooner after the rally and more likely to get that blow off and then a decline. But sometimes it happens in February expiration, because March is a quarterly OPEX and creates much more dynamic kind of stress potential in the market as we saw during the COVID crash, right? We continue to rally despite knowing about COVID into Feb OPEX, and then saw a Feb to March cycle to the day that represented an over 30% decline in the market. And again, not a coincidence, which we've highlighted before as well.
Quick question for you. In your mind, in your analysis, when do you think the current populist period really began in this cycle?
So that's an interesting question. And obviously that assumes that it's like has a start date and an end date.
Right, of course, yeah.
Which it doesn't.
No. I'll tell you why I asked, and you can think about it. The reason is I'm kind of curious because your analysis has been so accurate, and the fact that you very, very early on this year started to talk about, be aware it's election year. Here's the analysis. This is what the data tells us. You just pointed out before that through that populist period, 68 to 82 or whatever, equities overall didn't move, but they moved a lot during the election years. The question for me is I'm trying to, and of course there's no guarantees here. So far, it looks like election years have been following that pattern, at least. My question is, do the years in between follow the same pattern as they did in the last populist period? That's kind of what I was trying to think about.
Yeah. So in terms of timing, populism, again, these are, when you're talking about big cycles, they rhyme, but it's not like something starts at one place and it ends at the other. The reason is because you need something idiosyncratic to happen to unleash what is a secular trend.
Right.
In our last data set that we talk about, the 60s and 70s, Kennedy was assassinated in 63. Kennedy had he captured the imagination, the beginning of a young populist feeling. His policies were incredibly populist. He was the originator of the Great Society program idea. The reason it got instituted was his passing. His passing was a unification of the country that allowed LBJ to pass that. That fiscal policy was the beginning, right, of the fiscal push that started the inflation. But if you look, it was happening well before Kennedy. Kennedy was a vehicle. Kennedy was a much like Trump is, right? He was a vehicle for this sentiment. The Vietnam War and all of the protectionism and things that were going on before Kennedy. But that swell was starting. I would argue that the populist pressure would have taken longer if Kennedy had not been assassinated. Right? Like it wouldn't have started, these policies would have started in 64. They might have taken to 68, and they may have taken something else would have had to have happened to kick it off. That's that one. Now, let's look at our current situation, which we understand much more in a refined way because we have been living through it, right, to an extent, right? Here in the U.S., starting in 2009, we started to get this beginning of this populist kind of push. That's a long time ago, right? Why did I say 2009? That's when the Tea Party started. That is when, at the same time, Occupy Wall Street happened, right? The personality of those were a young population who was disgruntled, but yet not quite to political dominance yet. And there was still an air of political conservatism and worrying about spending, right, that was involved in that. Ultimately, that was the beginning of kind of, or you could see it already coming at that point. But these cycles are tied to like ages and demographics. The baby boomers had to start, again, to think about this. We've had 15 years. Think about how many baby boomers have passed, and think about how far and retired or are no longer voting in some form or another, or applying pressure to the political system. And meanwhile, those kids who are doing Occupy Wall Street and 18-year-old are now 33, right? So the political winds have shifted as a function of demographics, because again, this is a critical thing that people don't understand. People think demographics is rich versus poor. It is, but it's also old versus young, because it's capital versus labor. And as you get older, you are more generally capital. And when you're younger, you're labor. And so the entities that have lived through this period of being disadvantaged because of inequality are young. And as they grow to political dominance, the zeitgeist, the political winds shift. That's a critical thing that people don't really appreciate. And so it took, every election is 4 years. It took several election cycles, and we started to see it. People wanted change. That's what Obama was about, because that was populism, right? Change. Why do we want change? Why did they want people didn't understand fully? It wasn't as refined, but it was tied to this inequality and this feeling of the system does not work for me. Well, that created more frustration by a lot of the entities and the labor, the real labor, which is more rural, right? Because it didn't represent them. It didn't represent them. It wasn't male focused. It wasn't white focused. It wasn't all the things that we know about, right? And that created a backlash by the way, people who have been, by the people who are also being disadvantaged, whether you're poor white in West Virginia or you're poor black in Chicago, like it's the same effect that is making you disgruntled. The problem is people start pointing at each other. And at the end of the day, the most disgruntled are probably the rusted out cities in middle America, because male white have been, even though the primary reason that all of them aren't performing have been hurt probably more because more female engagement in the last 40 years in the workforce, more minority involvement in the workforce. So even though the dreams that were promised in the 1960s and 70s, right, to minorities has not come to pass, and they're largely disgruntled for that, poor white men are in the U.S. Are looking at their fathers and their fathers' fathers and saying, we for 2 generations have seen massive decline. And so that anger and that populism in that population created Donald Trump. And the key unleashing here was 2 things. One, bringing the right left. So Donald Trump brought the conservative side, the non-populist side of politics, kicking and screaming to the left because he's a marketer. And he's really good at giving people or telling people he's going to give them what they want. And he saw a trend. And he told him, I don't know that he even realized it at first, but once he realized it, he went headlong into it. He told them what they want, which is populism. And bringing the right left, wow, that's now the whole thing's left. And whether you're AOC or Bernie Sanders, who have all seen, again, upsurge in their interest, or Donald Trump, you're populist now. And that paired with a catalyst, which was COVID, our assassination of Kennedy was COVID. And that released a massive amount of fiscal spending. And by the way, those policies were not just focused on that period in curing COVID. It was a crisis that was very much taken advantage of by politicians to institute populist policy. And populist policy that will stretch 10, 20 years, to be clear. Like we're just starting to see some of the fiscal populist impulses from COVID. So anyway, that's how it's played out. Now, so you asked me a simple question, give you a long-winded answer. I tend to do that.
I just wanted a year. I thought like this is going to take 5 seconds.
Sorry. So the answer is 2020,
okay.
Right? Because it's like the 64 for me. So if you want to just kind of look at a rhyme and see what the verse may look like, which is I think what you're going for. There's 18 years in there, 64 to 82. This probably goes to 2038 or so.
So what I actually was trying to get at was to think about how equities have behaved. So let's just say it's 2020. Okay, well, so far equities have doubled since 2020. So for now, you could say, well, it's a little bit different from last time, or maybe it's not. I don't even know exactly what the equity markets were doing. But what I'm trying to get to, because I think it might be a nice segue to one of the topics that I wanted to touch on with you, is the role of inflation. Because you can have the populists in society, but the question is, in my mind, is does that impact performance of equities? Or is it really what happens to inflation that is the one that drives the return during these periods. That's what I was trying to figure out. And I wanted your thoughts on that.
Yes. Inflation or interest rates, right? And the two things are intrinsically tied, are critical. Like that is where the rubber meets the road. That is the supply and demand. And that drives the market outcomes. But those are affected by the populism to such an extent that I would argue that this period, and I don't want to dive too deep into this because this could be another 2-hour show, but we had populist periods before the 60s and 70s, and they weren't inflationary, by the way, right? Like Great Depression was a very different world, very populist period. Interestingly, when you put markets in real terms, they have the same exact performance metrics. Literally the exact. If you just took markets to real terms and you looked at charts, literally that period, which is dramatically different because it was a deflationary environment, had very, again, in real terms, the same dynamics and nominal completely different. So important to note that in real terms, this populism and the dynamic effects we're talking about will likely play out this way. But in nominal terms, you'll have very different outcomes. And even the interest rate and inflationary dynamics will create slightly different supply and demand dynamics as a function and change path. But the difference now, and the reason we're more likely to be inflationary as opposed to something like the Great Depression, is because of the Federal Reserve and the power. The Fed was not around at that time, or at least dominant enough and their mandate is very clearly to avoid a Great Depressionary kind of volatile environment and to use nominal illusion, for lack of a better term, to manage the volatility of a cycle like this. Much better politically, you could argue not just politically and in terms of real outcomes too, to manage market volatility through these periods and use the shaving of coins, for lack of a better term, to manage the loss of real wealth than through something like the Great Depression.
But I get the impression that you are expecting some changes, if nothing else, certainly in the volatility of fixed income markets in currencies, which are obviously related to fixed income. How do you see this play out or interlink with some of the other things we've talked about?
Yeah, so the Federal Reserve is in an incredibly tricky situation here. Take politics out of it. Take Donald Trump.
Hard to do, but we can try.
Right, not out of it, but like take Donald Trump and his willingness to kind of take over the reins and do. We can talk about that as well. But they have a dual mandate. They have one tool, and they are being asked to do essentially an impossible task, which is control both an environment that we borrowed from the future and created structural inflation, right? And that structural inflation is likely to hurt both, right, at the same time. So they had an incredibly easy task the last 40 years. They were able to create price stability with excess growth through essentially infinite monetary policy because they didn't have a mandate on inequality. And they kept saying, our problem, our mandate. But of course, if you're managing volatility, you're removing crisis from the system, the political system is set up to not be able to pass laws unless you do have a crisis. You're by definition, it may not be your mandate, but you're by definition structurally creating massive inequality, and you will until things ultimately break. And so now, if we're going to deal with the inequality, not a political issue, now it's the political side problem. If we're going to deal with it, now the Fed completely has their hands tied. So given that, the Fed is going to be forced to try and manage the two sides of the equation. And when there's more inconsistency and less ability to control, right, volatility. We've talked about the Fed put for 40 years. If the Fed put is no longer truly valid or clear what they can or cannot do, what do you think that does to volatility? And where does that volatility express itself the most? And the answer is, historically, you can look at the data and we've talked about this for some time. We talked about it about a year and a half, 2 years ago. Historically, the greatest volatility during these populist periods does not come in equity markets. It does not come in commodity market, like precious metals, yes, because those are more of a currency, but does not come in energy markets or whatever. People would naturally think that would be the case. It actually comes in FX, yield, bonds, which makes sense, right? And precious metals. You have a time of deglobalization, a time of great global strife and global conflict. And on top of that, you have a time of Fed lack of control over economic outcomes. And so that's where you should be playing. We've had a relative to generally it's been increasing, the volatility broadly over the last 2, 3, 4 years in those areas, but a relative time and placidity there. And I think the coming of the election of Trump, again, is an acceleration point to that volatility. And those assets will be pretty wild. And actually that dovetails into our gold conversation. I don't know if you want to go there.
I was just going to say, because that's the other thing I really wanted to acknowledge you for, because a long time ago, probably more than a year ago, you first started talking about the opportunities you saw in a gold vol, in particular long-dated gold vol, and in particular call long-dated gold options. So congrats on that, but also what now?
Yeah. In 2021, 22, we started talking about time is flying. When gold was dramatically underperforming and oil was at near record highs in 22, right? And gold vol was in the gutter because it was just kind of dead money. It seemed like it at the time. And oil vol was through the roof. We said, look, this is a massive structural secular opportunity. And that was, very unpopular opinion at the time. Now it's not so unpopular, which is the reason why it's going to be more volatile. But yeah, we've obviously seen a massive surge in gold and gold upside call vol. The calls, importantly, it's not just vol in general. Like the calls were massively, like the curve was flat and gold calls absolutely exploded higher. Historically, actually the thing that I would most highlight to people, and recently with the gold decline, after Trump's election, people have been like, all of a sudden, never mind that we called this in 22, on so many different levels, like got this just right. People are all of a sudden losing some confidence in the rally. And the thing that's odd actually is that we actually haven't seen much realized volatility in gold in this rally. I want to be clear. When I say massive volatility, the best performing asset from the 68 to 82 period, not even close, is gold. But it was also the most volatile asset. Remember, we untied ourselves from gold, like in the US, it's a massive, like 50% type declines. So be prepared for volatility in gold. And if you think it's going to be a straight line and you're going to sell it as soon as it starts moving down, or, like you're doing it wrong. This is going to be, there's a reason we own calls and not stock, right? Or not the underlying asset, So anyway, prepare for volatility. Would it surprise me if it dropped another 20%? No. Would it surprise me if it rallied 50%? No, it wouldn't. The secular trend is up. It will continue to, and actually, by the way, the most likely time to get some volatility the other way, not surprisingly, is when everybody's all in. And these things cool down and get volatile when everybody is on one side of the boat. And it's been a very popular trade, whereas it wasn't when I first started talking about it. And so, yeah, expect when you start hearing people turn negative on it, that's when you start buying it with two hands again. And again, focus on volatility and the calls. They're still, even though it's a lot higher, still cheap. Because again, we're not talking short dated calls. We're talking long dated calls.
Maybe to round things off, talking about things that is linked to volatility in many people's mind. It's also linked to gold in many people's mind, but it's not real gold, it's virtual gold. It's Bitcoin. 100,000, pretty close to that level. There's new Bitcoin ETF options coming. What are your thoughts about Bitcoin? I don't even know whether we want to go further than Bitcoin, because maybe it is different to the world of crypto.
So more long-term, meaning this period we've talked about, right, that we're in, not long-term 50 years, right? Next decade, Bitcoin is millennial on down gold. Gold is not a commodity in the sense that it's valued because of its industrial capabilities. Yes, there's some portion of that. That's not what's important. It is a store of wealth. And it has value because people believe in it, right? This is part of why it's so volatile, because it can also, all of a sudden, people can lose belief, right? Bitcoin has captured the belief of these generations. And if they are the ones that are coming to political dominance, the ones we want to be looking at it, like what they want is what's likely to happen, probably don't want to bet against Bitcoin. And then maybe it takes some of gold's upside off the table because people are buying Bitcoin as well. Now, the difference is gold's been around for, 100,000 years, right? This has been around for, 20 years. And so we start talking about 20, 30 years, there are bigger questions. I think until sovereign entities start adopting it as a currency, I think there are concerns longer term. I've talked about this, but I think you have to have a situation where the entities in power don't see it as a threat. There's a reason the U.S. unpinned itself from gold, because it constrained the U.S.'s power. And Nixon's untying of the dollar from gold gave the U.S. infinite power, essentially. And to be clear, if the U.S. ever lost the exorbitant privilege of the U.S. dollar, incredibly, never mind the size of the military, anything else, that's by far the biggest power. But that's not going to happen overnight. And you better believe, whether you're China, which has already showed that, is banning Bitcoin, right? Or the U.S., at some point, if it gets big enough and it becomes a threat to the exorbitant privilege of the U.S. dollar, that's a problem. And so there is a cap on, is it 13 million, which I think Michael Saylor is calling for in Bitcoin? Maybe. I'm skeptical of that high, because again, at some point there's gravity to this in the sense that it does not have a sponsor. Now, to be clear, these big things work in that mysterious ways. And I want to be clear, like Donald Trump and Elon Musk, bringing Elon into this picture and the talk of adoption of Bitcoin, again, I think it's completely not in the long-term best interests of the United States, but maybe it's in the short-term best interest for them politically and for centralizing their own power. And so, yeah, short-term, don't get in the way of Bitcoin. If the one big overhang is regulatory and long-term kind of, access and openness, Bitcoin's been worried about the SEC, right, and regulatory overarching kind of Federal Reserve control over it, et cetera. That's the main headwind for it, right? But if that's why after Donald Trump and Elon victory, this is just taking off. It's not just a narrative, by the way, and narrative matters, but it's truth. Like you're taking the biggest risk off the table for Bitcoin in the next 4 years.
One last thing I'm curious to know about, and I would phrase it as a kind of a neutral question, even though it may have it may have certain feelings attached to it because it is about Elon Musk. But I'm curious about your thoughts about having someone like him, whether you like him or hate him, doesn't really matter. But someone with that mindset, giving at least some kind of job description to make government more efficient. And and then he's being joined obviously by another Silicon Valley person for that, Vivek. And I'm curious because for so many years, I think we could probably all feel that government is just growing and growing, and it's not as efficient as you would think, whether I look at Denmark, whether I look at whatever country. So the experiment, as I would call it, having two people like that influencing efficiencies is interesting to me. Because if it works, maybe that's something the rest of the world should pay attention to. So, politics aside, what do you think about that experiment?
It's a big question, right? We don't know. But I find it really, really, really interesting that at the same time that we are amidst this populist period, that it is popular to gut government. I think that's probably not going to end well. Those two things are in almost diametric opposition to one another. Donald Trump, regardless of how you feel about him, these are facts, came on board in 2016 with a very populist mandate and populist messaging, and did some very populist things, particularly tariffs and protectionism. However, his biggest policy change, which is the tax cuts, were the exact opposite. Right? He, again, everybody likes tax cuts, so and everybody felt like, we're getting something. But 95% of the benefit of that went to corporations and wealthy individuals. And you can do those things and pull wool over people's eyes, but at some point that just exacerbates populism and makes things worse. Now, Donald Trump might be able to gain more control. He's on to the Supreme Court and through other pathways now, Trump versus US, like legally he has more ability to pull levers and secure more power in the system. And trust me, he's going to try and do even more in the next 4 years. And so he might be able to overcome what's likely to become pushback over time. Again, I'd like to highlight that whether it was Nixon or Kennedy or LBJ or Ford or Carter or, none of them lasted long in office during this process. It is a tough time to be president. It is a disadvantage to be an incumbent.
We know already he's only going to last 4 years, right?
Well, yeah, that's what Erdogan said in Turkey, right? So you don't know. Again, people think it's impossible, but there are.
You mean if he changes the law and he could do another?
There's all kinds of interesting things that can happen. I would not. I know you can pin that of having talked about that and saying that's a higher probability than people expect. Doesn't mean he's going to change the laws and make it.
Sure.
That could be it. But you could put his child in office and blah 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 and yada yada, right? Like he's at some point he's got to pass, right? But the point is the impulse and what he stands for, and the point is that is likely to become his policy as well is likely to become unpopular in 4 years. Now again, he can manage that with power and other things and potentially extend that. Now, but I'm saying that in the sense that Donald Trump could very well gut the system, and which is really good for business and wealthy individuals and corporations, not good for the populist, giving populists what they want. And at the same time, kind of do tariffs and do stuff which are much more marketing wise. Oh, look, I'm doing populist things. And so if he takes this kind of dual pronged approach, which is not necessarily what happened during the 60s and 70s, My guess is it'll extend the populist cycle a bit. And the path will be a bit different. And it might actually make it so that the poor performance may extend the cycle a bit in terms of equity performance and other things. And then this kind of more dead kind of cycle may get pushed out or be, more volatile down the road. But, something to watch for. The impulse is the impulse. The political winds and the demographic realities are not going anywhere. That's not going to change. And if you don't give the people what they want, it's going to, stick around and get worse. And so I would watch the policy, pretty confident he will do some of the populist things like immigration policy and tariffs to some extent. And those things will continue to be populist. But I would look under the hood and see, what is happening on the other end. And the regulatory end is a big piece of that. If they completely do what they're saying, which it's going to be hard for them to do, by the way, and just start gutting, different parts of the government and restructuring, I don't think it'll make people happy in the long run. Again, if you gut Social Security, people are going to be happy. If you gut, housing and urban development, people are going to be unhappy. If you gut, go to the budget, there's a reason government exists. Government exists because, without it, rich people get richer and poor people get poorer, and it's survival of the fittest, and you get a, part-built system. And that's what we're trying to fix. So there is a populist impulse. He can do it to kind of gutting the system and burn it all down is a feeling, right? But I'm guessing if they don't burn it down and build it back up the right way, if they just burn it down, that won't be pretty, I don't think, politically for them in the long run.
It will certainly give us lots to talk about the next 4 years, Cem. This was an awesome conversation. I really appreciate all of your insight. It was wonderful to review some of the old things and see how they played out so well. Obviously, now people have come to expect just to listen to you, Cem, and know what to do with the portfolio. So stay tuned. There'll be a lot more of that coming. If you want to show your appreciation for all the work that Cem puts into this, please go to your favorite podcast player, leave a nice message, rating, and review. We so appreciate that. Next week, I'm back with Rich and a surprise guest, I think. So that's going to be super fun. And if you have any questions you want us to tackle, feel free to send them to info@toptradersunplugged.com. From Cem and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, as usual, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.